Hello student, I hope you are safe and healthy. Today we are going to learn chapter 6 foreign exchange rate and BOP. This is the last chapter of macroeconomics. Let's begin. Okay, before moving to this chapter, let's think it that for your higher education after class 12, you want to move to any foreign country, let's say Australia, where you want to do your further education, for which you require Australian dollar. Where you get it from or how you will get it. This chapter will help us to know all more about it. So let's start with what is foreign exchange rate. So foreign exchange rate refers to the rate at which one unit of domestic currency is exchanged for the currency of other countries. In other words, it is the price of one country's currencies in terms of another country's currencies. For example, if $1 is equal to 70 rupees, then the exchange rate for $1 will be 1 by 70 dollar, and if similarly if 1 pound is equal to 90 rupees, then the exchange rate for 1 rupee is equal to 1 by 90 pound. Now, what is foreign exchange market? Foreign exchange market is the market where or in which the one country's currency is traded for other country's currency. It is known as forex market. As we said it before, that where you get your foreign exchange. Mostly the central bank assigned to the commercial banks to do this foreign exchange under the supervision of central bank. In India, it is Reserve Bank of India. So if you need any foreign currency, you have to go to any commercial banks, and by converting the Indian currency into your required currency, they will help us to do that. Now, what is foreign exchange market doing, or that their function? The first function is that it is transfer the purchasing power from one country's currency to another country's currencies. That is the transferring function. As I said that you need the US dollar. Now Indian rupees is converted into the US dollar. So it helps us to transfer your purchasing power into US currencies. Now it provides the credit for international trade, that is credit function. Credit function is generally allowed for forward market system. There are two type of market system is there. One is called spot market, another one is forward market. Spot market means when you are doing your transaction take place both the purchase, if you purchase the goods and you are making payment on at the same time, then it is known as the spot market. There is no future payment. But when you are making order today and the payment will take place in the future date, then it is known as forward market. That means credit transaction. So in case of credit transaction, foreign exchange market help us to perform this credit function under the forex market system. Now another part is another function. It helps to provide or giving the provision for hedging facility. So hedging facility is basically when the exchange rate is determined by the market force, that is flexible exchange rate system, under which the rate of exchange every time gets changed. It may increase or it may decrease. So there is all the time it become uncertainty is there, and hedging function help us to minimize the risks of uncertainty. So that is the forward foreign exchange market help us to do this hedging function. Now exchange rate system, it is basically the fixed exchange rate, flexible exchange rate or floating exchange rate, managed floating exchange rate. Under fixed exchange rate system, the rate of exchange officially fixed and remain unchanged by the government or monetary authority of the country until next official declaration. So in this system, government and monetary authority of both the countries, they decide the exchange rate, and it will be remain fixed until next official declaration. It depends on the exchange rate is depends on the gold reserve of the countries. If one country's gold reserve is more, in that case their currency value will be higher than the other country's one who has less gold reserve. So that's what the fixed exchange rate decided, and this will be remain unchanged until next official declaration. So we'll be learning merit and demerits. That's what I have put it here. The gold reserve for the fixed exchange rate system, if you want to get the facility of your currency, domestic currency purchasing power, you have to keep huge amount of gold under fixed exchange rate system. Under flexible exchange rate system, the exchange rate is determined by the market force, that is demand and supply. Demand and supply, if the demand is more, exchange rate will be higher. If demand is less, exchange rate will be less. And at the same way, the supply part, if your supply is more, rate will be less, and vice versa. So it basically the microeconomics that you have learned, law of demand and law of supply, it's act over here, and the rate will be decided by the market. That's why it is decided, it said the force, market force. Under managed floating system, which is in which the central bank allow the exchange rate to be determined by the market, but intervenes at time to influence the rate. When the central bank finds that rate is too high, it starts selling the exchange rate from its reserve to bring down it. So this basically it's talking that your rate will be decided, exchange rate will be decided in the market, but when the rate is increased more, then reserve bank or the central bank of a country will intervene over here. That's why sometimes this managed floating is also known as dirty floating, because the central bank is intervene over here to reduce the rate. When the rate is high, they reduce the rate by selling off their gold sometimes or the foreign exchange reserve, and that's how it is called the managed floating or dirty floating in the exchange rate system. Now merits and demerits of fixed exchange rate system. Merits of fixed exchange rate. Number one is stable exchange rate. It is obvious because the exchange rate is remain unchanged until next official declaration. That's why until that period the exchange rate will be remain unchanged. So the stable exchange rate is prevailed in this fixed exchange rate system. It promotes the capital movement and international trade. So if there is no change in the exchange rate, so there is a minimum risk is there in the rate fluctuation, and because of that international capital movement and international trade, they find the less risks for movement. Next one is no scope for speculation. Speculation is not possible in this exchange rate because it is remain unchanged. Speculation means over here that when the rate is low, one buy at less price, and when the price is increased, then it sell to get the profit. But since the exchange rate is remain same, that's why there is no question of speculation. Next one is force the government to keep inflation in check. So it is also help us government to reduce, to control the inflation, because if there is no inflation, no fluctuation in the exchange rate, so when you are importing goods at the same price, the price will be remaining same for the domestic producer, and they are not going to increase the price. Sometimes if the import price is increased, they increase the price because cost of production is increased. But since the exchange rate is remain unchanged, so there is no question of increasing the price. That's why inflation can be checked. Next one is it attracts the foreign capital, because if you are providing the stable exchange rate, then the foreign capital movement is possible. They will be investing, foreigners will investing more in your domestic industry. So that is merits. Now we go for the demerits of fixed exchange rate system. Need to hold more gold reserve. As I said it before, that in the fixed exchange rate system we require more gold reserve. Next, no automatic adjustment in the balance of payment. Automatic adjustment is basically it is an adjustment which keeping in view to earn the profit. So that is no adjustment is required in the balance of payment. We learn in detail this one later. Next one is it may result in undervaluation and overvaluation of the country. Since it is not decided by the market force, demand and supply, it is decided by the two governments, two countries government or official. That's why it may be undervaluation or overvaluation. So of the domestic currency it may possible. It discourages the objective of having free market. Obviously it is the discourage the optimum rate is not decided, uh, because it is not, the rate is decided not in the market by the market force. Flexible exchange rate. Under flexible exchange rate system we find that no need of gold reserve. We don't require gold reserve anymore. It is decided by the market. So it lead to automatic adjustment in the balance of payment. Automatic adjustment it is required. It is there. No, to enhance the efficiency of the resource allocation. So when the rate is decided by the market force, then equilibrium exchange rate is determined, and because of that your optimum resource allocation is possible under flexible exchange rate system to remove the obstacle in the transfer of capital and trade. So is sometimes in the fixed exchange rate there is a possibility of capital obstruct in transfer of capital from one fixed exchange rate to another country who is following the flexible exchange rate. So in that case there is a, but if everyone is following the flexible exchange rate system, then it removes the obstacle of transferring the capital and trade. It eliminates the problem of undervaluation and overvaluation. Obviously it is, since it is decided by the market force, that's why there is no question of undervaluation and overvaluation, because the rate is equilibrium exchange rate. It promotes the venture capital in the form of foreign exchange. I think you need to know what is the meaning of venture capital. Venture capital is basically a startup, those who are doing startup business and having long-term objective to have a profit. For them this venture capital is there, so it helps to them, those who are having starting the new business and keeping in mind of future and long-term future profit, and they want to go for long term. That basically it is venture capitalist, they are basically known as venture capital. So it is promote them to get the it promote the venture capital in the foreign exchange. Demerits. So fluctuation in future exchange rate, you don't know what will happen tomorrow, so always uncertainty is there in your mind. So uncertainty means risk involvement is there. So encourage speculation. Obviously if there is a all the time fluctuate, every time it's fluctuate, if today is more tomorrow is less, today is less tomorrow will be more, if these kinds of things fluctuation is going on, then the speculator will take the chance, they buy at lesser price and sell at higher price, they get profit. Discourage the international trade and investment. If your rate is continuously unstable, it is fluctuating, then international trade is means the trader, those who are investor, they will be in the risks, more risks. That's why they uh, will not invest in your domestic country's market. It create the situation of the market instability. Obviously, when there is a rate is going on, keeping going on changing, every time change, then instability take place. Now, demand and supply of foreign exchange. The demand of foreign exchange has inverse relationship with the foreign exchange rate. As we know it, the law of demand, that the demand of foreign exchange will increase with the decrease in foreign exchange rate and vice versa. Now, the why we demand foreign exchange. First one is when we purchase the foreign goods and services, we require the foreign exchange. When we buy the financial assets for foreign companies, if you want to invest your money in foreign company, buying of shares, debenture, bond, etc., we require foreign exchange. We directly invest in shop, factories, building in the foreign countries. Suppose you want to open one business in Canada, you require foreign currency. You want to send gift to your friend who are staying abroad, we require foreign currency. To speculate on the value of foreign currency, as we discussed earlier, the speculation purpose. To undertake the foreign tours, foreign education, medical treatment. If someone is moving to foreign countries, they require foreign exchange. If you go for further education in abroad, you require foreign currency. If your medical treatment, for the medical treatment, that also require the foreign currency. Now, supply has positive relationship with the foreign exchange rate. If supply of a foreign currency is rises with the increase in exchange rate and vice versa. If rate of exchange is increased, supply will be more. So likewise, the source where we get it, that foreign exchange. First one, direct purchase by the foreigner in the domestic currency, domestic market. So if the foreigner wants to buy the goods from our domestic product, foreigner is buying. Direct investment by the foreigners in the domestic market, foreigner is investing in our domestic market. Remittance by non-residents living abroad, someone is your family working in Australia, they are sending the money, then we'll be getting the Australian dollar. Flow of foreign exchange due to speculation purchased by the NRI, non-resident Indian, so we are getting it. Export of goods, if we start exporting goods, we obviously get the foreign exchange. Next one is the foreign direct investment and portfolio investment from the rest of the world. If the foreigner is directly FDI, we call it the FDI, or they invest in our domestic company, then we get the foreign exchange. Now, determination of equilibrium exchange rate. So as you know it, that the equilibrium exchange rate is determined by the market force, where market demand is equal to market supply of foreign exchange. So under the free market situation, when market force, that is demand for foreign exchange, and supply of foreign exchange, when both are equal, in that case the equilibrium exchange rate is determined. So we are showing it with the help of a diagram. We have demand and supply curve as DFE, indicating the demand curve slopes downwards to the right, and SFE, that is supply of foreign exchange, which slope upwards to the right, are intersecting at point E. And equilibrium exchange rate, therefore, it is determined as OR at the point of equilibrium, and equilibrium exchange quantity is determined as OQ. That is how the equilibrium exchange rate is decided. So as I am discussing over here, that the adjacent figure we are showing the demand and supply curve are intersecting each other at point E. As a result, equilibrium exchange rate OR is determined at point E, and the equilibrium exchange quantity is OQ, where the market demand and market supply of foreign exchange are equal. Now let's take example of if the demand of foreign exchange is increased, then we'll know it that the demand curve will shift rightwards as it is showing it, and the new equilibrium point is determined at point E1. At the point E1 where the demand is higher, you will find the exchange rate also increase from OR to OR1 and equilibrium exchange quantity as OQ1 as we are showing it. So sometimes the question comes, if the equilibrium exchange rate is determined at a point E, and from that point, if the demand or supply is increased, then how it will be effect on equilibrium rate and equilibrium quantity, you have to show it. So in that case, you can, if demand is increased, you shift rightward. If demand decrease, you shift leftward. If supply increase, you shift supply curve rightward. If supply decrease, if you can do the supply curve shift leftward, and accordingly the new equilibrium point you determine, and from there you show the effect of equilibrium exchange rate and equilibrium exchange quantity, how it is, whether it is increasing or it is decreasing. That's how the determination of foreign exchange rate under flexible or floating exchange rate system. Now certain terminology we have to learn it. First one is devaluation of currency. When the government or monetary authority of a country officially lower the external value of the domestic currency in respect of all other foreign currency is called devaluation of a currency. It takes place by the government order under the fixed exchange rate system. So you have to, sometimes what is the depreciation and what is the difference between depreciation and devaluation. Devaluation, it is under fixed exchange rate system and it is decided by the government or monetary authority of the country. Both the country, they have decide and bring their value. One of the country, they will bring down their value in respect of the other country's currency. That is known as the devaluation of currency. This has happened when their gold reserve is decreased, foreign exchange reserve is decreased, purchasing power of the domestic currency is also decreased. In that situation, devaluation take place, and that you have to remember, it is under flexible a fixed exchange rate system. Now revaluation, it is opposite, just when the domestic currency's value is increased by the government or monetary authority of a country, and that also officially declare, then it is known as the revaluation of a currency. This has happened when your gold reserve increase, purchasing power of your domestic currency is increased. In that case, revaluation takes place. Now what is the depreciation? The depreciation of a currency, that the current domestic currency value is decreased in terms of foreign currency, and it is decided by the demand and supply of a currency, and it is decided under flexible exchange rate system. So this part you have to remember. One is devaluation, which is under fixed exchange rate system, and another one is the depreciation, this depreciation under flexible exchange rate system. This part you have to be very careful, because sometimes question comes, what is the difference between devaluation and depreciation of currency. So devaluation under fixed exchange rate and it is officially decided, whereas the depreciation, it is decided by the market force under flexible exchange rate system. So these are basic two difference, you have to learn it. I hope you understood. The next part, the currency appreciation. If the purchasing power of a domestic currency is increased in the market, in the flexible exchange market, then it is known as appreciation. that is also under fixed exchange rate system. So these four terms you have to: appreciation, depreciation, devaluation, revaluation. Devaluation, revaluation under fixed exchange rate system, depreciation, appreciation under flexible exchange rate system. Now we are going to learn the balance of payment, next part of our lesson, in which we are going to learn what is the balance of payment, what is balance of trade, and what are the different components of balance of payment. So now we start with the balance of payment. What is balance of payment? It is basically systematic record of all economic transactions, both visible and invisible items, that is goods and services. Visible means goods, invisible means services, between the resident of a country and the rest of the world during a financial year. So it basically talks about the record of all international economic transaction, that is export and import of goods and services. This one is visible and invisible items during a period of 1 year or during a financial year. So now, what is balance of trade then? Balance of trade is therefore, it is the systematic record of visible items. This one is important. Over here, visible and invisible items, but balance of trade is talking about only visible items. So that's why it is incomplete record of balance of under balance of payment or macroeconomic policy. That's why balance of trade is not included in the estimation of national income, because it is incomplete record. Sometimes the difference between balance of payment and balance of trade is there. What is the difference? So you have to say that balance of payment, it is a systematic record of both visible and invisible items between the resident of a country and rest of the world during a financial year, whereas balance of trade is only recording only the visible items. That's it is a incomplete record, and that BOP is included in the national income, whereas BOT, balance of trade, not included in the national income, estimation of national income. That's the difference between balance of payment and balance of trade. Now next, what are the component of BOP? So we are, since it is BOT is incomplete, so we are not going to learn anymore. We learn detail of BOP. So what are the different component of BOP? So it is include the visible items, that is export and import of visible items. That visible items also known as another term called merchandise. This merchandise word. Merchandise means the visible goods. So the uh, visible items. So one of the component of balance of payment is visible. It is a visible both export and import of visible items, that is merchandise. Now uh, invisible items, the include of receipts and payment of services. For example, shipping, banking, insurance, travel, receipts and payment of income on foreign exchange, interest on foreign loan, remittance of NRIs, etc. Government current expenditure in abroad, wise expenditure on embassies, etc. Transfer payment and receipts, all these are invisible items, that is part of services. As we discussed earlier, that invisible item means it is service. So all the service related transaction will be accounted under the BOP. Next part is the capital transfer. Under capital transfer, the all transaction between the normal resident of a country and the rest of the world causes the change in assets and liability. That is important. The assets and liabilities, that basically talks about the capital transfer, change the position of assets and liability of a country, that is purchasing of assets or repayment of loan. These are capital transfer. We learn detail component later part. So this capital transfer during an accounting year. Now like foreign loan, foreign direct investment, banking capital movement, etc. Now thus balance of payment is equal to balance of visible items plus balance of invisible items plus balance of capital account. If this part is equal to 0, then we will call it the balance of payment. Now structure of BOP, we have capital account and current account, as we discussed that first part is the current account BOP and the second part is capital account BOP. We learn detail the current account BOP. So current account BOP refers to the transaction related to the goods and services, income on investment, unilateral transfer. BOP on current account reveal the net income of the countries generated in abroad, both visible and invisible component. This part is balance of current account balance, that what net is there, how much we are getting as compared to giving. So this part accounts basically export and import. The items you have to, will be learning detail again, that what are the detail item under current account. So it is basically the goods and services, what are the export and import is there. Then if whatever the interest income, dividend income which you are receiving from abroad or we are paying to the abroad, and both these all accounts, okay, this part, net part, what we are receiving and what we are paying, that part is known as balance of uh, current account balance or surplus or deficit. So when we get it, if the next part is if export and import of visible items are equal, we call it the balance in current account BOP. If the export of visible and invisible items is more than the import of visible and invisible items, then it is said to be the surplus in current account BOP. And last one, if the export of visible items and invisible items is less than import of visible and invisible items, then it is known as the deficit current account BOP. So the part is there that if it is equal, both export is equal to import, then we call it the current account BOP balance in current account. If there is, if export is more than import, then we call it surplus of current account BOP. If the export is less than import, then it is known as deficit in current account BOP. This part is important in this part. So we go for learning the next part. The component of current account BOP. Component of current account, as we discussed it, that it includes the export and import of physical goods, that is visible items. Invisible items include cost of non-factor services, investment income, and unilateral transfer. Unilateral transfer means one-sided payment, that is remittance or donation or gift. These are come under the unilateral transfer. Now non-factor services include the transportation, finance to travel, that is the invisible items. Now the service rendered by the resident of a country to the rest of the world are recorded on the credit side. This part is important. If your inflow is there, that recorded in the credit side of the. So humanities student, you have to very carefully remember this part, because commerce student may understood what is credit. Basically it talks about the income, that inflow, that's why it is shown in the current account credit side, or positive items, sometimes it is called positive items. So you can remember this one, positive item or credit side enter all inflow. If your any transaction causes inflow of foreign exchange, then we call it that is dot enter in the credit side or positive items. Any transaction related if causing that outflow of your foreign exchange, then it basically causes it enter in the debit side or negative item. Like for example, I'll give the export. If your goods is export, then we'll get the foreign exchange. So it is inflow of foreign exchange, that it is recorded in the credit side. Whereas if we import the goods and services, then your foreign exchange outflow is there, and that's what it is enter debit side or negative item. So this part debit side you have to remember. Question will be asking you giving certain element items, that whether it will be included debit side or credit side in capital account or current account. So you have to remember all physical, visible and invisible goods are included in the current account. If there is inflow, that it is positive or credit side. If there is outflow, that it is negative or debit side of current account BOP. This part if you remember, it will not be very difficult to understand that which side it will appear. Now, income of investment include interest payment, foreign loan, credit, foreign loans and credit, transfer of profit, miscellaneous for patent, royalties, etc. Interest and dividend payment made by the foreigner are recorded in the credit side, and vice versa. Opposite are vice versa recorded. Now, unilateral payment. Unilateral payment, I said it that it is one-sided payment without getting any return. So it includes gift, grants, donation, and military aids, technical assistance. All these are when it is getting as a aid or scholarship, as we discuss, or allowances getting from the government or foreign countries, then it is known as unilateral payment. So if you are getting it, your inflow is there, then it is debits, it is credit side or positive item. If unilateral payment made to the foreigners, then it is outflow, it is entered in the credits debit side of the BOP, current account BOP, or it is negative item. So this debit and credit, all items you have to remember. Now capital account BOP. Capital account BOP, as I said it that earlier also, that it changed the assets and liability position of a resident country during a period of 1 year or accounting year. In other words, it record the capital transaction, that is private and official capital transfer, as well as banking capital outflow. So international transaction in financial assets, for example, bond, equities, loans, bank account, etc., fixed plant and equipment, and direct investment, any direct are recorded in the capital account. So the component of capital account are basically private capital transaction. It refers to the transaction that affect the assets and liability of a resident country. If one resident, they are buying any foreign assets, foreign goods as an assets, then it will change the position. Or if they are making payment directly, for any loan if they have taken from the foreign country, then that is private capital transfer. Now official, that is from the government, that if it is any official transaction take place and causing the change in the position of assets and liability of the government, it includes loan, repurchase and resales of securities, gold to the foreign resident, next debt service, gold and foreign exchange service, miscellaneous receive, payment, etc. Banking capital, the different bank has foreign branch also there. They time and again they have to send the money to the foreign branch, that known as foreign banking capital transfer transaction. So it also under the capital movement, capital BOP or BOP on capital account. Now we learn two important terms. One is autonomous, other one is accommodating items in balance of payment. So autonomous items are those items of the balance of payment which are related to such transaction, such are determined by the profit motive, for the profit maximization motive, to maintain, not to maintain the equilibrium in balance of payment. These items are generally called above the line items in the balance of payment. So it basically, if any transaction take place and because of that the economy is going to get the profit maximization, that are known as the autonomous transaction or autonomous items. It is basically called above the line items of the balance of payment. Under accommodating transaction, that take place because of other activity in balance of payment. These transactions are not meant to get the profit, it is just to restore the balance of payment identity. Such items are generally called below the line items. So it is just taking just to restore the balance of payment identity, then it is known as accommodating items. So it is government intervention is there, and autonomous is basically it take place automatically. I mean, by looking at the term you can understand one is government intervention, that is accommodating, and it is not meant for the profit motive. It's just to make the balance identity, export and import are making equal, otherwise deficit of balance of payment will happen. Whereas autonomous is just completely meant for profit motive. You government is trying to make government or country is trying to make more profit by exporting, more exporting, less import. That is basically under the autonomous and accommodating items. So now balance of payment, therefore, as we discussed earlier, balance of visible items plus balance of invisible items plus balance of capital, if it is equal to 0, then it is known as balance of payment. So, or in other word, we can say it that the current account balance of payment is equal to current account balance, current account receipts, capital account receipts equal to current account payment and capital account payment. If you take it, then it is known as balance of payment. If you take it, change the side, you will get 0 ultimately, which is given in the first equation. The deficit in BOP is said that current account and capital account receipt, if it is less than current account and capital account payment, then it is known as the deficit or negative balance in BOP. Surplus opposite, if current account and capital account receipts are greater than current account and capital account payment, that is surplus of BOP. So both deficit and surplus are known as disequilibrium in BOP, which is not good for the surplus is good obviously, but then deficit in BOP is not at all good for the economy. So what is the causes of disequilibrium in BOP? Disequilibrium in BOP are causing because of economic factors, as we given certain points over here: cyclical fluctuation, huge public expenditure on development project, hike in inflation, which includes large import. You are importing more and more goods from the foreign country. That's why your import cost is more. Exporting less export is there. That's another reason. That uh, change in cost structure of the trading partner in the countries, demonstration effect, which implies the effect of developed economy of lifestyle and consumption pattern. As the your economy citizen, if their consumption pattern change, they import more from the foreign goods, foreign commodities they like more. Even the less price it is available in the domestic as a domestic product, instead of that they buy it foreign goods they prefer to have. That is basically called the change in lifestyle and consumption pattern. That's why your import is more you are importing. So that is economic factor. When your more import is there, your consumption pattern is change, your lifestyle change, that cause economic factor. Political factor is basically it is the all the time the your political unstable is there. That's why different government is giving the more promise to the to get the vote, basically to people, giving the more attractive things, and because of that they are spending more and more money. More import is there, more loan they are taking from the foreign countries. Unstable government, like we know it that the Pakistan presently going on, they are taking more of foreign loan. That is political instability, one of the reason. Social factor, social factor it's basically another causes of that your propensity to consume comfort and export are less. Your propensity to consume is more is there, your savings is less. Whatever your income is there, you are spending more and more on consuming, then it is causing the disequilibrium, means more import it will be required. So these are the different causes of disequilibrium in BOP. Now how do you correct it? As deficit BOP, definitely it is harm to the economy. How do you correct it? So this part some points is mentioned, that your depreciation of external value of domestic currency, that is one major. so that you will get less value. As you are importing goods, you will get less value, so it is discouraging to the importer or those who are buying it, the foreign goods. If they have to pay more money, then obviously they will not import the goods or buy the foreign goods. Devaluation of currency, if it is fixed exchange rate following, then devaluation will be works over here. Exchange control restriction, that you are exchanging the goods, import restriction is there. That you like gold price, if you check it, that we are government is trying to impose more and more excise duty, that's why gold price is more, that is discouraging that you try to import less gold from the foreign country. Tariff and import duties, they are hiring increasing more and more. Fixing of exchange quota, that import quota, that certain amount you are eligible to get it, after that you will not be able to import, that is quota fixing. Next is export promotion measures, that you have to be given more and more encouragement to the domestic producer trader to export more and more goods, so that people less import and balance balance of payment will take place. That's all. This. Thank you.